Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of JSW Steel Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is now being recorded. I now hand the conference over to Mr. Ashwin Bajaj, Group Head of Investor Relations at JSW Steel Limited. Please go ahead, sir.
Yes, thank you, Peter. Good evening, ladies and gentlemen. It's a pleasure to welcome you to JSW Steel's earnings call for Q1 FY23. We have with us today the management team represented by Mr. Seshagiri Rao, Joint Managing Director and Group CFO, Mr. Jayant Acharya, Deputy Managing Director, Mr. Rajeev Pai, Chief Financial Officer, and Mr. G.S. Rathore, Chief Operating Officer. We will start with opening remarks by Mr. Rao and then open the floor to Q&A. So with that, over to you, Mr. Rao.
Good evening to everybody. This quarter, which has gone by, was one of the toughest and challenging quarters, particularly on the back of Russian-Ukrainian war, which has brought in extreme uncertainty and extreme volatility in the market, particularly commodity markets. So this has given a major shock in the steel market. Total pattern of global trade has changed, and the largest ever increase in the energy prices, and all got further aggravated with the sanctions on Russia and trade restrictions, labor shortages, logistic bottlenecks. Over and above to contain inflation, the contractionary fiscal and monetary policies that are being followed by countries and central banks. So this has caused a lot of uncertainty and volatility in the markets. To contain inflation as the major objective of several countries and the government, they have changed the policies, they have changed the priorities. The Indian government, in line with that, have imposed export duty also in the month of May of 15% on export of steel. So all this together was a challenging quarter. But what is interesting, if I really see the world steel industry, the overall steel production, in my view, has increased quarter on quarter. Generally, the impression is year on year, the steel production for the first 6 months of the year have fallen, but which is not really true. The largest producer and consumer of steel, that is China, quarter on quarter, their steel production went up by 16.5%. They produced 284 million tons as against 243 million tons, which is 40 million tons more steel China has produced. What did they do? Their exports went up by 54% in the Q2 over Q1. They exported 20 million tons of steel as against 13 million tons in the Q1. So all this, if you see country by country overall trade flows, there is more production, more exports, falling demand, and reducing imports. So this has caused a fall in the steel prices. There is a fall of over 20% in the global steel prices. Maybe in Europe and US it is much more. So this is the context in which we have delivered the results from JSW. One more point which we observed as far as the Indian steel industry is concerned, completely in contrast to what I just explained in the global markets. When Chinese steel production sequentially went up, Indian steel production sequentially came down, but year on year it increased. So this is majorly, in my view, attributable to the imposition of export duty which has brought in a big psychological factor in the user industry. With that, if I see as far as JSW Steel is concerned, we have produced 5 million tons of crude steel on standalone basis. We have preponed certain shutdowns. Otherwise, we could have produced at least 0.5 to 0.7 million tons more production in the last quarter. So our Indian operations, including Bhushan Power and Steel, we produced 5.62 million tons. Our capacity utilization in Bhushan Power and Steel was 89% as against 103% in the Q4. Our capacity utilization in the existing operations, other than Dolvi expansion, if we look at it, also came down to 93% from 98% in the Q4. So therefore, we have moderated production. Otherwise, production could have been higher. If I see the sales are concerned, because of export duty imposition, when the steel exports from India came down by 26%, even our exports in the last quarter came down by 35%. We could do 883,000 tons of exports as against 1.35 million tons in the Q4 of last year. So exports have fallen by 20% of the total volume of sales. Consolidated sales, including Bhushan Power, was 4.33 million tons. The blended sales realizations, because of price hikes that have happened in the month of April, overall blended basis, it went up by 9% in the quarter. Whereas cost pressures were very high. As we guided in the last call, that the coking coal impact would be there in this quarter to the extent of $125 per ton. We are seeing $113 increase in the coking coal price. The iron ore fall in the prices have not fully reflected in the last quarter. So altogether, cost went up by 21%. That's why on standalone basis, the EBITDA per ton was 8,311 rupees per ton. That is 10.8%. The coated business also has not done well because of a huge amount of inventory losses in the company. Plus, their export could not take place. Both together, volumes also did not do well. So both together, there was a negative EBITDA as far as coated business is concerned. Bhushan Power and Steel made an EBITDA of 698 crores, 14,541 rupees EBITDA per ton. So the domestic subsidiaries net contributed, including Bhushan Power and Steel, 743 crores. Our US operations, 34.2 million, both Ohio and Baytown together. Italy was positive, 4 million euro. So overseas contributed 276 crores. So the EBITDA on a consolidated basis, 4,309 crores. EBITDA per ton on a consolidated basis is 9,601 rupees. But there are 4 one-off items which are very, very important for us to understand. These one-off items are, one is the BPSL compared to JSW Steel. These are the two main reasons why you find apparently the EBITDA of BPSL is higher.
Okay. The second question is essentially on the cost guidance for this quarter Q2. What kind of coking coal reduction and iron ore reduction per ton of steel do you see?
So coking coal, we are likely to see a reduction in the range of $50 to $60 per ton, going from quarter one to quarter two. Iron ore, the reductions which have happened in the market have not been reflected fully. So part of that reflection will come in the quarter two. And given the fact that international prices are moderating further on iron ore, we do expect some moderation going ahead in this quarter.
Is it possible to quantify the iron ore reduction as you have done for coking coal?
Iron ore, different areas, different locations, we will have a different number because, based on the FE, so it's difficult to quantify a number.
Okay. Thanks and all the best.
Thank you.
Thank you. Our next question comes from the line of Pinakin Parekh with JP Morgan. Please go ahead.
Yeah, thank you very much, sir. So my first question is trying to understand exports. At this point of time, given where the export duty is and given where the export realizations are, would the company be exporting any steel at this point of time?
Yes, we are exporting steel, basically to certain locations and certain products, but the export volumes are far lower than our normal volumes. Naturally, given the fact that the export duty makes it totally unviable, and secondly, the general moderation in the global demand as well.
Sure. So my second question is, given if the export duty is not removed in the course of the year, would it be fair to say that the volume guidance on sales given for FY23 would see downside risk?
So we do not expect the export duty to continue for long. This was a temporary measure to contain inflation. We have seen in the inflation numbers, if you see while it is not fully translated yet, the component of steel price in inflation has fast gone down. So we do expect moderation going forward or removal going forward. So we see this as purely temporary, and maybe in H2 the opportunity to export will come back.
Understood. Thank you very much.
Thank you. Our next question comes from the line of Vishal Chanda with Motilal Oswal Financial Services. Please go ahead.
Yes. Thank you very much for the opportunity. Sir, just following up on the iron ore, generally the lag in purchase and consumption is about 15 days compared to about 2 months for coking coal. So I would presume that there would be a fair amount of visibility on the iron ore pricing, given the fact that almost everything is localized. So could you please just give us a sense of how much lower was it in Q1 versus Q4, and what kind of ballpark number it would be probably in the next quarter?
Vishal, here in the case of iron ore is concerned, we have captive supply and also we buy in the market. We buy in the market, I agree with you. But in the case of our captive supply, 52% of the total consumption of iron ore is now from captive in the quarter one. So in this case, what is happening is the premium which we have to pay on the auction mines to the government is based on last declared IBM price. IBM, there is a lag of 2 months in declaring the price. Number two is, if you compare the IBM prices vis-a-vis the market prices, IBM prices are not getting adjusted in line with the market prices. There is an anomaly. That is why we are hesitant to give a view on what would be the iron ore price, because as on date, IBM declared for April. May-June price not yet declared. So there's already 2.5 months lag as on date. So whatever we consume, whatever we dispatch in this month, we have to pay premium based on April. And whether, as and when IBM declares the price, whether premium will get adjusted like royalty, there is an ambiguity in law. So therefore, there is a dispute which is going on even on that. That is why IBM, the iron ore price, were hesitant to give how much it would be the impact.
So that is absolutely clear, and thank you very much for this elaborate answer. Now, my second question was with respect to the overseas operations. Do we foresee in the near term to close down European operations, at least given the fact that there have been quite a number of challenges since we have acquired them?
No, so in the last quarter, if you have seen, the European operations yielded positive EBITDA. The rail orders from RFI, which the pricing also got clarified, so therefore we were able to get a positive EBITDA there. Going forward, we are expecting that the rail orders from the Italian rail will be forthcoming. With that, we expect to maintain, a positive kind of an EBITDA going forward. While we are looking, we may continue to look for opportunities, maybe to partly divest the assets in case there is a possibility or economic sensible possibility to do so. But we may continue to hold the rail mill in the asset.
Thank you very much, sir. I have questions. I'll join the queue.
Thank you. Our next question comes from the line of Indrajit with CLSA. Please go ahead.
Hi, thank you for the opportunity. I just have one question. So you also highlighted downward pressure on global iron ore prices. So, and we have seen global steel prices now hovering around $600 per ton. Chinese coking coal prices are now much lower than maybe Australian, or coking coal prices have softened as well. So with that light, how do you see global prices as we head into seasonal weakness in China? And do you see as a result we could start seeing some bit of imports coming back into the Indian market?
So yes, we have seen some import into India from Russian sources. Not as much from the Chinese yet, although their exports have been elevated. But the Russian ruble being now far stronger, we see a reluctance from the Russians to offer that kind of a competitive pricing going forward. On the Chinese side, while the export volume, because of COVID restrictions in China, the exports have also increased, but their costs, are elevated. The $600 which you are talking about are spot deals which are being done by traders, which are offloading stocks, to de-risk their working capital. It is not something which is being offered by primary mills, since the cost doesn't support this price. So my sense is that given the current cost 1 and a drop of 4,000 rupees in quarter 2, which is in July-September. And quarter 1 pertains to April-June. So we are still in discussion with some of the auto majors to close these numbers. Some are already closed, some are in the process of getting closed.
Okay, my question on the coal side was more on power cost, I think, on the thermal coal side. So the increase in power cost that we have seen, will it sort of stabilize here or come off? How do you see it?
It will moderate because we are using a mix of different coals as well. So the power cost will also moderate.
Okay. Thanks. That's all from my side. Thank you.
Thank you. Our next question comes from the line of Satyadeep Jain with Ambit Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. First question is on CAPEX. I think recently you indicated increase in CAPEX in Vijayanagar. With the recent moderation in commodity inflation and stuff, is there possibility of that being revised down, or have you already placed an equipment order? And how do the next budget for the next 3 years, how would you look at the CAPEX for the next 2 years after 15,000 crores of CAPEX this year? That's the first question.
So you have to look at little medium term when we are committing capital expenditure as per our strategic plan. So India, we are very optimistic with regard to the overall building infrastructure and also other sectors of the economy. Either you take auto, you take packaging industry, you take renewable industry, appliances. They all have a lot of big potential. Whereas there are very few players in India who are capable of creating new capacity. So that is why we are not changing our plans on the CAPEX for expanding our capacity by 7.5 million ton at Vijayanagar, nor expanding capacity at Bhushan Power and Steel to 5 million ton. So they are on track. They already placed orders. Project work is in full swing at the site. Only what we have reviewed the capital expenditure is relating to special projects, other discretionary projects. So our view on the outlook or growth is still demand in India, it remains intact.
And so what would be the CAPEX after, so you're looking at 15,000 crore this year. Are you still maintaining that 48,000 crore of CAPEX guidance as we sit here today for the next 3 years?
So only this 5,000 we have put it on hold. So 48,000 remains for the next 3 years. So as and when situation improves, this 5,000 crores we will take a call.
Okay. Secondly, on the entire decarbonization CAPEX, you indicated, I think 10,000 crore of CAPEX, including 1 gigawatt of renewable energy. What is the remaining CAPEX that you would expect to be incurred in the 10,000 crores? And is there opportunity to add more WHRS in the existing units? I think in the upcoming plan, you're looking at WHRS. Is there potential to capture more of waste heat from CDQ and stuff in the existing plants that you have?
No, we have already have 2 plants using the coke oven gas and the other heat at Dolvi. That is 175 megawatt one unit, just commissioned a few days back. There's another 60 megawatt, there is one more plant which will get commissioned by September. So this 170 plus 60 is 230 megawatts at Dolvi is majorly to use the heat and the gas that would come in the process. So the way we are working as a part of decarbonization is or reducing carbon emissions is to replace our entire coal-based power plants with renewables. We are in the direction, this 958 megawatts we have signed with Digital Energy, 225 already started. Balance will start in this financial year. Over and above that, we are also looking at seriously to commit for more renewable power in future and replace the existing fossil fuel-based power. In addition to catching the fuel, the heat and the gases that are there in the process to generate power.
Okay. Thank you.
Thank you. Our next question comes from the line of Prashant Kumar Kota with Dolat Capital. Please go ahead.
So thanks for the opportunity and congrats for good results in a very, very challenging quarter. Adjusted for one-off, the results were really not that bad. And sir, my question, Jayant sir has just touched upon the topic of export duty and it may be removed, etc. But then there are some unanswered questions, sir. Now that have been lingering in our mind. It's been 2 months that the export duty was imposed on and the restrictions were imposed on our sector. Sir. So, but if we just look at the rationale and the logic, there are 4 or 5 areas which are really contrasting to the actual logic, not logical actually. So the first one is, so steel industry as a whole is very, very challenging industry. And that's why the market as a whole also gives us very low valuation. For example, if you see the gross block versus the market cap, we get 1x. Versus various other sectors, it's 10, 15, 20x. So that is a very challenging space. And market is wise. The second one is, sir, there are many sectors and hundreds of smaller and larger companies also, which sell branded products and when raw material prices increase, they increase the price of the end product. But when raw material prices decrease, they don't commensurately decrease the prices, sir. The prices linger for a significant amount of time and it pinches the retail, sir. And third one, sir, and there's some impression management, influencers and management that probably other sectors are able to do well and we are not able to manage properly. Because we see recently when on the oil and gas sector, when there was this cess, etc. imposed, many market participants, veterans came out and said, this is a bad move, it will spoil the impression of the country, etc. But when it came to steel, when the duties were imposed, everyone said, yes, it's a good move, prices will decrease. So even we are a private sector driven enterprise, private capital. So why this one, sir, anomaly? And in just 15 days, when crude prices fell from 5-10%, the cess was over. Yes, agreed, export duty and this cess are not similar in nature. One is based on production, one is based on...
Prashant, sorry to disturb. Can you please come to your question, please?
Sure. Yes, just finishing that. So hence, what we can say is, my view is that the prism lens used to evaluate the steel sector is not uniform and is not comparable to what is being used for other sectors. So with huge respect and regards to the Honorable FM, etc. means and the government, why this stepmotherly treatment with steel? Sir?
No, Prashant, thank you very much for pointing out this. And as an industry, what is that we can do is to bring the facts to the attention of the government and seek their intervention to ensure that fairness is there. So we, as an industry, through Indian Steel Association, represent it to the government. We appreciate the step of the government to impose export duty not only on steel and some other items or put some restrictions with the noble objective of reining inflation.
to June, is it possible to share how are July NSR with respect to 1Q as an average?
It will be difficult for us to, we don't usually give NSR numbers. So difficult to give you a number right now because today there are various moving parts. What we are trying to do, I can tell you, is that we are trying to increase our domestic in the interim. So what you will see is more of domestic volume and less of export in the short term. Our focus is to see that our value-added steel focus continues. So our value-added sales continue to be promoted. We continue to look at our branded portfolio and concentrate on sales of that. So that to some extent will reflect. We also see good movement in the automotive. As we said, the automotive demand is quite positive. We see a good traction in underlying demand in most of the products and most of the sectors. So demand perspective, I think we are cautiously optimistic for this quarter. So therefore, the domestic parts in the channel inventory is very low. The domestic component of the sale will be able to make up some part of the loss in exports. And since the export prices are also internationally, as we discussed, have gone down, therefore, to some extent, it will offset, on a mixed basis, some of the drop which has been there between quarter one and quarter two. But I would be more cautious to say that, yes, volume part, we are more optimistic. Margin part, I would say that the situation improvement we will see once the cost comes down from October onwards.
Understood. So my second question is with respect to the coated business. Now, the margins there has been quite volatile in the last many quarters, from 10,000 rupees to now a loss, and I believe this quarter there will be some one-offs in that business as well. So, I mean, from a value addition and from a long term, given the amount of value addition we have and the downstream units we have, I mean, what sort of mid-cycle margin one should assume in this division?
The EBITDA impact on coated, which you see, is primarily on account of NRV provision, which is basically on higher cost of inventory, which they are holding, which basically is a mark-to-market which has been done. So we feel that going forward, coated margins also will improve, not to the levels which we have seen last year because of a higher level international price. But it would go back to maybe earlier numbers which have been prevalent in the coated space.
Understood. And one just last clarification. I mean, what sort of inventory days do we have for the coking coal? And Mr. Rao explained that 2 months lag on the IBM price for iron ore premium. Is it a provisional payment where once the say for example May June IBM price is updated, the payment is reversed or adjusted for future payments, or is it a permanent payment and there is a permanent 2 month lag?
Number one, coking coal, we have around 60 days inventory. Then coming back to IBM question, in the case of royalty payments, the procedure is same. As and when dispatches happen, royalty is payable depending upon last declared IBM price. As and when IBM declares the price for the month of dispatch, there is a provision in the mining rules that it will get adjusted, either upwards or downwards. Similar rule is not there in the case of premium. So therefore, there is a grey area where some clarifications are being sought from the government. Hope they will clarify and things will be put to rest.
Understood. Okay. Thank you so much and all the best.
Thank you. Our next question comes from the line of Ritesh Shah with Investec Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So, two quick questions. Initial demands indicated Chinese steel exports have actually increased on a monthly basis, on a quarter-on-quarter. Sir, how do we see the trends over here? That's one. And secondly, any hopes of further stimulus or policy action from China which can actually improve the sentiment?
We were not able to hear the first question very clearly. The second question, I'll answer first. Maybe you can repeat the first question. Second question, yeah, China the government is providing stimulus to drive the economic activity upwards, especially post the real estate challenges which they are facing and the COVID lockdowns which continue to be a challenge. So we do see that some impact of that stimulus will be seen in the short term. As far as your first question is concerned, if you could kindly repeat that.
Sir, I refer to the Chinese steel export volumes which have actually bumped up. How do you see the trend over here? And also if you can give some flavor that you indicated that global steel trade patterns have actually changed.
Yeah, so Chinese exports have moved up to close to 7.7 million tons in the last 2 months. But that is also primarily impact of the COVID lockdowns and therefore impact of consumption in the domestic market, manufacturing as well as real estate, which consumed a lot of amount of steel. But going forward, if the COVID restrictions ease and the stimulus takes effect, we feel that the exports may moderate somewhat. But we'll have to watch that space because China remains unpredictable. So we'll have to watch and see how that thing moves.
Just to add to the point, if I just take the Chinese apparent consumption in the Q2 was higher by 13% over Q1. In spite of that, their exports went up. That means they produced more, 96 million tons they produced in the month of May. But there is a moderation in the month of June, already came down to 90. So the expectation is one is stimulus increasing the domestic demand. Number two is adjusting the steel production in line with the local demand instead of relying on exports. These two things together, I feel exports will get moderated from China.
And they've also declared that they would like to maintain their production at the level of last year.
Correct.
So if you see that and the run rate required, it seems that the production will get moderated to 2.75 million per day from the 3 million plus levels which are going on today.
Sure, that's very helpful. So my second question is, we called out for spread expansion potentially into Q3. We also indicated the coking coal cost decline which can happen in the next quarter. So my question is basically how should one look at local pricing? Factoring one is import parity math, and secondly, would it be even fair to look at it on export parity basis? Just trying to get some sense, given we have called out for coking coal, how should one understand the local pricing?
So export parity pricing, no, that usually doesn't get. The norm is basically based on import. But import, the depreciation of the rupee and the volatility in the general import is also is making many customers hesitate to go too much into the international market. So I would say import, you will have to use your numbers based on import plus a certain premium which the domestic customers will be willing to pay.
Sure. Thank you so much.
Thank you. Ladies and gentlemen, we request participants to limit their questions to 2 questions per participant. Our next question comes from the line.
Hi, thank you for the opportunity to ask questions. I wanted to understand how you think of dividends this year, given that you're facing higher costs and a bit of margin contraction as well. Thank you.
We have already communicated our dividend policy. It is 15 to 20% of the consolidated net profit. As the company has done extremely well last year, the board has taken a decision for the approval of the shareholders, which got approved, that is upper end of the range. We declared last year 20%. This we have been consistently following. So in the future, we will follow a similar policy, 15 to 20% of consolidated net profit.
Okay, so this year you plan to pay about 20% as well. Is this correct?
No, I'm not saying 20. This is a range. 15% minimum, 20% is outer limit. Within that range, board and shareholders will take a call. In the last year, it was 20%. But this year, based on the profitability and the cash flow requirements, board again will take a call in this range. 15 minimum, 20% is the highest.
Okay, thank you.
Thank you. Our next question comes from the line of Bhavin Chheda with Enam Holdings. Please go ahead.
Yeah, good evening, sir. So first question on these overseas operations, this plate mill and pipe is seeing very good traction of EBITDA. Is that sustainable going forward?
So the U.S. operations, the plate mill in Baytown is doing quite well. The demand pattern on the plate side is positive. While on the coil side, you may have seen that the prices have corrected, and there has also been a destocking which has happened in the U.S. as well. Going forward, the gap between coil and plate which exists today may correct. It may not remain at this level. Currently, the plate prices are at $1,800+ per short ton, whereas coil prices are in the range of 50% of that. So there would be some correction on the plate, but the demand on the plate side we feel is going to be positive. Especially the transition to renewables calls for a lot of plate, especially the wind sector. Then the barge requirements, the infrastructure requirements also are consuming plates. And given the fact that Russia and Ukraine were plate exporters and that is out of the market, we feel a demand perspective, plate will continue to be better than the coil in the U.S. operations.
Yeah. So second on the particularly the power and fuel cost, which has seen sharp escalation. So I'm assuming a majority of this is also an impact of the gas consumption cost at Dolvi operations, because that I think gets accounted in power and fuel, because I believe coking coal gets covered in the raw material head. So this power and fuel spurt, is it driven by gas consumption cost?
Yes, that's correct.
And obviously that's the formula base, so that is not coming down in the immediate term till the crude prices go down sharply.
It depends upon index, the gas index, because there are 2-3 gas indexes are there. So we have contracts, some are linked to JKM and the balance are linked to Henry Hub. So based on that, it goes on changing.
Right. And
Mr.
one
Chheda,
last
this
question,
is
sir.
the operator. If for any follow-up questions, please.
Okay, I'll come back.
Thank you.
Thank you.
Our next question comes from the line of Love Sharma from Lombard Audio Investment Managers. Please go ahead.
Hi, thanks. Thanks for the call. Just wanted to understand a few things. So given that the margins are likely to remain subdued currently for this quarter and next quarter, in terms of the deleveraging, given the debt build-up has been quite significant due to the capex and the growth the company has seen over the last few years, could you share any thoughts around how the cash flows could be managed to ensure there is some deleveraging which we could see going forward?
If you see the total increase in debt, I tried to give the breakup, the reasons for increase in the debt. Out of 10,500 crore increase in the debt, 6,800 crores is only on account of inventory accretion. So this is possible to bring back the cash flow into the business and reduce the debt during the financial year. 1,400 crores is only on account of exchange rate translation. Then 1,200 crores against 3,700 crores of capex we have incurred is the incremental debt which has come in as a part of this 10,500. So if you take that into account and considering this financial year's balance 9 months performance, we don't expect the debt to go up. By end of this financial year, it will be lower than what we are seeing for this quarter.
Understood. Okay. Should we expect it should be stable to FY22 number?
Our effort is not to increase FY22, but this is an aberration which has come in the last quarter. Our effort is to bring down the debt to FY22 level.
Okay. And can you tell me the acceptances? How much is the acceptances outstanding currently?
I think I have given the number already. We have 2.7 billion acceptances on revenue account and 13 million on capex.
Okay.
Mr. Sharma, for any follow-up questions, please come back in the queue afresh.
Sure. Thank you.
Our next question comes from the line of Amit Murarka with Axis Capital. Please go ahead.
Hi. Thanks for the opportunity. So first question is on exports. My understanding is that there's about 2 months lag in executing the export orders. So is it fair to say that on the export side, whatever you do in Q2 at least is where the hit will come of lower prices, and Q1 has not seen the hit of lower prices on exports?
So the export orders which have been there carry forward from April, May, I think have all got executed. Whatever orders are now being taken are orders taken in month of June, let's say, for execution in July. So you will see whatever volumes you will see of exports now will be current order based.
Yeah, and also just on the duties, you mentioned that it's unviable now to export, which is understandable, but semis are exempt from duties. So, does it not make sense to try to do some semis exposed to the extent you can?
Yes, we are doing some semis export in this quarter. Some in the special grades and some of the semi exports to our facility in Italy as well.
Right. And what happens to the DEFRACO order under the long-term contract?
Mr. Murarka, sorry to interrupt. This is the operator. For any follow-up questions, please join the queue afresh.
Okay, sure.
We move on to our next question. The next question comes from the line of Kamlesh Bamgar with Prabhudas Lilladher Limited. Please go ahead.
Yeah, thanks for the opportunity and good performance in this quarter. So one question on the part of your one-offs, how much was the export duty, NRV provision, and FX rate fluctuations in standalone and subsidiary?
NRV provision in the standalone is 787 crores and in the consolidated 813 crores. Forex fluctuation in the standalone account is 598 crores and the consolidation is 747 crores. Export duty in the standalone is 136 crores and in the consolidated is 242 crores.
Okay, thanks. And second question on the part of steel prices, say the way the coking coal prices have fallen. So does government want any assurances on the part that over a period of time as the cost has come down, so the prices or the steel prices should also be at a level significantly lower than the current what they are trading at or ruling at?
I think the way you have to see is that the steel prices have come down by more than 20% from the levels which it was, let's say, beginning April. Number two is that the prices currently of steel prices which you see are lower than what it was 1 year back. So therefore, we are saying that given the fact that the coking coal prices still are higher, even after dropping vis-a-vis the last year, we feel that by and large, steel prices will remain range bound. There is not too much scope for prices to further correct.
For the steel prices are delicensed and I don't think it will be controlled. What Government of India has done, as I mentioned in my opening remarks, is only to contain inflation. They have put temporarily the duty. So this duty will go away. I don't think government will ask the companies how to fix the steel price.
Got it, sir. Thanks a lot.
Thank you. Our next question comes from the line of Anuj Singla with Bank of America. Please go ahead.
Yeah, thank you very much for the opportunity, sir. So just one question on the mix between domestic and exports. Given the export duty, what are we targeting for second quarter, and what can we look forward to in case the export duty is removed in the second half, which you are expecting? What can we see the whole mix for the full year?
No, the export proportion, if you see, it varied in our company from 12% to 30%. That is the range. So last quarter it was 20%. So depending upon the pickup in the domestic market, which we expect it will revive in this quarter, so we will be in that range, 12 to 30. So we will not be able to say today, okay, we will do definitely 20. We will not go down below 12.
Okay. So 12% is a minimum benchmark there.
Yes.
Okay. Okay. And the second question, sir, with regards to the maintenance shutdowns which you have taken at the various facilities, given that second quarter is typically a seasonally weak quarter, do you think a reversal of that is quite likely in this quarter, or that can extend into the second half as well?
The JW Ispat, the joint venture company, there it is continuing as on date because cost structure is still high. In the case of Bhushan Power and Steel, in fact, the expansion to 3.5 million ton is getting completed in this quarter. Then at Vijayanagar and Dolvi, we will just watch the markets, and if something can be preponed, part of it we will see if markets don't recover. Otherwise, there is no plan to prepone anything. We would like to continue the production as we had planned.
Okay. Okay. Thank you very much, sir.
Thank you. Our next question comes from the line of Abhiram Iyer with Deutsche Bank AG. Please go ahead.
Yes, sir. Thank you for taking my questions. The first question that I had was on the revenue acceptances. So this has increased significantly into Q1. Any particular reasons for this, and is this expected to correct because these are treated as sort of debt-like instruments by your rating agencies, right? So your external rating agencies. And the second question, just as a follow-up, is in case you're seeing forex sort of blow up, especially considering a significant portion of your debt is in US denominated bonds, is there any plan for the company to sort of repurchase or buy back some of these bonds in the market?
As per acceptance, increase is concerned is majorly attributable for increase in coal price. Coal prices which used to be $100, we bought at $650 per ton. So therefore the acceptances have gone up. But now this coal prices got corrected, this will also come down in the next 6 months' time. As regards to buying of bond is concerned, we continue to watch the situation and then take a call on that. As on date, we have to work within the RBI guidelines. If you want to buy back the new loan which we are raising, it should be lower than what you had earlier raised that is getting retired. And the new loan should have a maturity longer than the loan getting retired. So it will be very difficult to comply with these two conditions. Therefore, we have to watch the situation and then take a call.
Got it, sir. And just a follow-up on that revenue acceptances when you mentioned it. This will correct down, as you mentioned, within the next 6 months, as coking coal goes from 650 to less than 400 that it is right now.
That's correct. Today 230 is not 400.
Got it, sir. Thank you very much.
Thank you. Our next question comes from the line of Ashish Kejriwal with Centrum Broking. Please go ahead.
Yeah, hi. Thanks for the opportunity. So 2 questions. One is about coking coal average price to be lower by $50 to $60 in Q2. Is it possible to share how much is the spot coking coal price versus quarter one average? How much lower?
Coking coal. So the quarter one average, as we said, is about $421 CNF India. The spot, as Mr. Rao just told you, is today, as we speak, is $230 for PLV FOB Australia.
But 421 and 230 different.
Not comparable.
Yeah. Because we continue to buy.
Comparable numbers, is it possible to share?
Sorry?
The comparable numbers to 421?
It is already given. If I say $50 will be reduced, 421
yeah.
50.
Correct. You take $50 from 421.
No. $50 you were talked about for second quarter average because of our low holding at the spot one versus first quarter? How much it can be lower? Can it be lower by more than $150, or how it is?
Just to clarify what we have said, whatever has gone into consumption in the Q1 was $421 C&F.
Yeah.
Whereas in the Q2 we are guiding that this cost will come down by 50. That means 421 minus 50. Whatever we are buying now or in the next 2 months, that average cost will come as a consumption in the following quarter. The next time when we have the call, we will tell you that. Because it's very difficult for us in the next 2 months how the coking coal prices will move.
Okay, no issue. The second question is, what we have been hearing is that lots of cheap imports from Russia is coming, and which is going to arrive at our port in September, which is around 152,000 rupees per ton. So, considering that export duty is still levied and it's not profitable to export, and cheap Russian imports are coming at much lower than what the current price is, what's our thought process for going forward for our domestic steel prices in September?
So actually, the way you have to see the Russian cargoes is that there are 5 cargoes which were booked in India from Russia. They range from 61,000 rupees down to maybe 51, what you said. But that's not the average. The duty also will be applicable on imports of Russian arrivals. So on an average basis, if you were to look at 55,000 rupees and on top of that duty, you will not be too far from the domestic numbers.
Okay, fair enough. Thank you for that clarification.
Thank you. Ladies and gentlemen, that was the last question for today. And now I hand the conference back over to the management for closing comments.
What we can say at the end is that in the quarter 2, we feel that the domestic demand will recover. Already we are seeing increasing inquiries from various end users. So domestic volumes will be robust relative to what we have seen in the Q1. Number 2 is input prices are coming down, either coking coal or the iron ore. So that benefit also will come. The third point is whatever guidance we have given of 25 million tons of total steel production and 24 million tons of total sales on a consolidated basis, notwithstanding a slightly lower sales in the Q1, we will be able to achieve this guidance. So with that, thank you very much.
Thanks for joining us. Please feel free to reach out if you have any further questions. Thank you.
Thank you. On behalf of JSW Steel Limited, that concludes this conference. Thank you for joining us, and you disconnect your line.